Good morning, everyone, and welcome to the panel on capitalism, stakeholder capitalism. Now, I think everyone has a poll that has been opened up. So the question is, which do you think is the better model for corporate finance? Is it stakeholder capitalism, shareholder capitalism, or are you undecided? Okay, so for the next 75 minutes, we're going to be talking about the role of corporates in sustainability and in the economy. And before that, I'd like to introduce our wonderful panelists for today. So I'll start with Joyce Chang. Hi, Joyce.
Hi.
Joyce is the chair of global research for JP Morgan. She's been in this role since 2014. And prior to that, she was the global head of fixed income research. She began her career as an emerging markets strategist and has been voted top analyst multiple times. Before joining JP Morgan, she was at Merrill Lynch and Salomon Brothers. Now, interestingly, she's on the board of Trickle Up and Girls Inc. and the senior sponsor of JP Morgan Investment Bank's Women on the Move network. So we might be talking a bit about that later. Joyce has been named in the top 25 most powerful women in finance by American Banker and included in Barron's inaugural 2020 list of the 100 most influential women in finance. Moving on to Dr. Muhammad Umar Swift. Hi, Dr. Umar.
Very good morning.
Dr. Omar is the CEO of Bursa Malaysia Berhad, and he's also director of all Bursa's subsidiaries and is the chairman of Bursa Malaysia Derivatives and Clearing. He's got more than 25 years in financial services and was formerly the CEO of MAA and Gas Malaysia. He's on the board of SITC and the Capital Market Development Fund, and he's got a Bachelor's of Economics from Monash, and he's the fellow of many things and on the board of many things. Moving on to Nick Kaur. Hi, Nick.
Hi, morning, everybody.
Hi, Nick. Nick is an economist and head of research at Khazanah National. He heads the knowledge management team at Khazanah and oversees operations for Khazanah Research Institute. Prior to this, he was an economist at Malaysia's Economic Planning Unit, directly involved in national development initiatives. He's got an MPA in International Development from Harvard Kennedy School and completed his undergrad in economics in Harvard College. He has a monthly column on the Edge Malaysia, and he also has a website, nicholascore.com. It's actually very interesting, and I would be talking about quite a lot of things from there. All right, so maybe as a start to the session, I just wanted to pose two facts for the audience here to kind of just chew on and digest. Fact number one, there are 40 times more people on the planet today than there was in 0 AD. 40 times today versus 0 AD. In year 1800, we had 1 billion. But for most of human history, less than 200 million. Today, we have 8 billion. Fact number one. Fact number two. The GDP per capita difference between the world's highest earning country and lowest earning country is 416 times. 416 times between the richest country and the poorest country. So the fact is, there are a lot of us, and we are today already using the planet's resources, and there's going to be even more of us. The thought is whether a constantly and rapidly growing population and consumption, i.e. constant growth, how feasible is that on a planet that is finite? Secondly, the distribution of wealth is completely not even, 416 times difference. So how do we have a planet that supports everybody, but is more equitable. So the question then comes, who is responsible for all this, right? Who is responsible for, saving humanity from extinction, if I were to put it pessimistically? Is it the government? Is it civil society? Is it individuals? How about businesses? So today's discussion is about business role in this, and we call it stakeholder capitalism. So the first question, which I think there is the poll on, the first question is, should businesses be responsible? So if we could have the poll results, which I can't actually see. Do we have the poll results? No? Okay. Well, I hope you can see the poll results because I can't. But just before we go into the conversations, I would also like to remind everyone that you can ask questions, and we actually highly encourage you to ask questions. Please post your questions on Slido, because that's where we'll be pulling the questions from. There should be a link on your app or your screen with the Slido website. So please put your questions there, and we'll try to get to as many of them as possible. Right. Okay. So thank you. I've got the poll results now. Stakeholder capitalism, 60%. Shareholder capitalism, 29%. Undecided, 11%. Excellent. Okay. So I'm going to now turn this discussion over to our panelists today. So maybe starting with Joyce, and then I'm moving on to Dr. Omar. Do you think stakeholder capitalism is important? Are business responsible, or does it miss the point? What do you think?
Well, it's great to be here with everyone to discuss this topic, but I'm with the 60%. I think that stakeholder capitalism is here to stay. So we are really living through a pandemic that has changed the way that we look at the world forever, the way we work, engage, spend, consume, and assemble. And I think what this has done is really heighten in focus on sustainability and created the awareness on daily behavioral decisions that really change the outcomes. That's what this pandemic has done. And just taking a look at it from a JP Morgan investment point of view, what I see is that COVID-19 has been a great leveler between the E, the S, and the G in ESG. It's no longer just about climate change. It's about the social and the governance. And what I am seeing in the corporate community is an acceleration of the trend of stakeholder capitalism and challenges to shareholder primacy, as companies are really now expected to contribute to societal demand. And I think you're going to see more acceleration of this trend for a number of reasons. First, I think you will see regulatory changes that establish more rigorous corporate governance requirements that are being adopted globally. Europe has been in the lead on this. European companies have been more advanced in adapting their corporate governance framework to change that advances stakeholderism. In the U.S., what we have seen is that COVID-19 has really put the spotlight on pandemic resiliency, accelerated changes in corporate behavior. It's highlighted the need to assure that you have health and safety and resiliency of the supply chains in place. And I think what we've also seen in the U.S. is that with the focus now on growing inequalities and the economic toll from COVID-19, we have seen much more of a movement for racial justice igniting over the past summer. Public and corporate views that are evolving as increased shareholder activism from the shareholders has really demanded greater focus on advancing diversity and equity. And so just as an example, what JP Morgan had announced in October 2020 was they announced a new long-term commitment aimed at advancing racial equity, accelerating climate solutions. You committed an additional $30 billion over the next 5 years to provide economic opportunities to underserved communities, particularly in the Black and the Latinx communities. So I don't think that this is a passing phase. I think the challenge now becomes not that this is something that is nice to have, it's something that you must have. And the question is, how do you put it into place and still ensure profitability, accountability, and how do you put it into place in a way that is sustainable? So I think the debate really has moved beyond shareholder primacy versus stakeholderism to accepting that we actually are going through a paradigm shift. A shift towards stakeholder capitalism where responsibilities need to be shared in a more equitable way.
Thank you, Joyce. Now, maybe over to Dr. Umar. What do you think of stakeholder capitalism? And you're in a kind of a position where you're both the exchange and regulator as well as a company, so you kind of see it from all three perspectives. But what are some of the changes that you're seeing in the attitudes of companies towards stakeholder capitalism in ASEAN and in Malaysia?
Thank you, Luan. I think we echo much of what Joyce has just shared with us all. I think the key thing is stakeholder capitalism, shareholder value. There is an alignment that is happening, and it's actually driven by what investors and shareholders want. Now, I think as we look at it in the Malaysian context, there's some 900 odd companies listed on Bursa. The top 100 are embracing stakeholder capitalism, if you like. And the real call to action has been the impact of the pandemic. The pandemic has been in some ways a great leveler. I think that term has been overused, but has also shown that the importance of good public health to everyone, the have and have-nots, because this disease just impacts all elements of society. But I think what I'd like to share with the audience today is the key thing is our behaviour drives stakeholder capitalism. If it is our values and the politicians that we elect and what we want as voters actually drives the change. If we were not, as consumers and investors, if we did not want stakeholder capitalism, it would not happen. I think there is a very real issue where you look at it, particularly from pension fund perspectives. How do you explain to, if you are saving for retirement, you want maximum return? So maximum return long-term or maximum return is measured on short-term gains and active portfolio management. I think these are conversations. But as we get back into the Malaysian context, when at the exchange, we prefer to encourage better behaviour, not greenwashing, and we want people to take on sustainability as an issue. So you've moved on to the three elements of ESG rather than just talking about governance or climate change, all the things that make it so much more important, supply chain management and so on, and the sustainability of your business. Now, I think the key thing then becomes we need to reward good behaviour, and that's very much a theme that I'll be touching on during our conversation today. Because if we do not reward good behaviour as an investor or as a consumer, frankly, if I was a director of a company, and I am a director of a for-profit company as well as a regulator and a few other things, we wear many hats at the exchange, I would have great difficulty in discharging my responsibility to my shareholders. And that's actually enshrined in the law as well as my constitution as an organisation. So when my investors tell me they want a certain behaviour, it makes it so much easier for me to embrace stakeholder capitalism. Thanks, Luan.
Thank you, Dr. Umar. Now, over to Nick. Nick has some interesting views and counter views to this, actually. So, Nick, what do you think?
Hi, Luan, and it's great to be here this morning with Joyce and with Dr. Umar. So I think first off I should say that my views are my own; they don't represent Khazanah's, right? Just in case I say something that that's a little bit controversial. So I think I guess to just answer the first question, which is should corporates be responsible and should they care about stakeholders? Absolutely, the answer is yes. I think I agree with Joyce that COVID has really shown us how interdependent we all are. And in fact, I don't know how many of you have watched the TV show Mad Men, but Don Draper, the lead character, has a really nice quote that I quote a lot actually, which is, "People will tell you who they are, but we ignore it because we want them to be who we want them to be." I think COVID-19 in society has really told us who we are as a society, and we shouldn't ignore it. And it's shown that we do need corporates to play their role in helping its stakeholders. I guess my issue is actually on a broader point on stakeholder capitalism itself, and it's something that we just need to be careful about. It's something actually that Dr. Umar alluded to, which is what do the people want, and what do the stakeholders want. But I think where it gets a little bit tricky is when we think of corporates in stakeholder capitalism making a lot of decisions for people who they think are their stakeholders, despite the fact that corporates need not necessarily be the best trustees of society. So the World Economic Forum, and this is a critique I have, they argue that stakeholder capitalism is a model where corporates become trustees of society. Well, how can you be a trustee of society if you're not democratically elected? And I think that's my main problem with some of these things where, Mark Zuckerberg, for example, with Facebook, right? I started the Chan Zuckerberg initiative, which is one way of being responsible. And I think that part is great, but that's giving money. At the same time, Facebook, as we know, is going through a lot of legal challenges at the moment with respect to everything from privacy to fake news and all these things. And that part, I think, is what we need to address. The sustainability work that corporates do cannot be divorced from the actual business practices that you actually practice. And I think sometimes we make that separation and say, like, okay, you know what? We'll make our money, and at the same time, we'll contribute in some other way. I think it all has to be interrelated. And ultimately, for things that really impact real issues in society, whether it's inequality, whether it's privacy, whether it's all of these things, I think you can't do it just with corporates. And that's why I think stakeholder capitalism as a model fails, because some of these are really responsibilities of society and government, and you can't depend on them alone. But to answer the question, should corporates be responsible? Yeah, of course. I think I think, as Joyce mentioned, it's no longer a debate. They should. The question is how. But I think at the same time, we do need to ask the broader question of, is it enough? And my answer is certainly not. Thanks.
Thank you, Nick. Right. So, Nick, you mentioned data and data privacy. Now, one of the things that the organizers kind of brought up was this whole definition of EES versus ESG versus EES and G, and now there is EESD, and the D is data stewardship. So maybe since Nick is on my screen at least, maybe I'll ask him first, right? So what do you think of this whole crazy alphabet soup? Is there a particular framework you subscribe to? Why?
I think first of all, if you believe that something is a good thing, then you should try to do it. Whatever alphabets you want to call it. In Khazanah, we follow the ESG thing, but I think even with ESG, a bit of a wonkish thing to say here, but I think what these alphabets do is really help us put a little bit of structure onto what it means to be responsible. Because the fact is there are so many ways to be responsible, and there's so many different measurements. So Bursa, for example, is asking companies to report on some of their sustainability measures, but that frames something, right? And I think the ESG kind of thing also frames, but we need to be careful of the framing, because we did some just a quick and dirty analysis recently, right? If you look at given companies, so Dr. Umar mentioned Tenaga, which is one of Khazanah's investing companies, right? Or at least he didn't. So earlier he mentioned Tenaga, but on different measures of ESG, one, whether it's Sustainalytics, which is one provider, and then ESG, MSCI is another provider, the correlation of companies that are ranked in terms of their sustainability is actually just 0.5. It doesn't tell us very much. So I think if you're going to choose any alphabet soup, just be very clear about what you're trying to achieve, and then from there figure out then how to do it without necessarily being too dependent on the existing framework. But it does help to frame the discussion. Thank you.
And we were halfway through the discussion about the alphabet soup. Was it ESG, ESG, ESGD? And I'm going to now turn it to Joyce about, which framework you use at JP Morgan and what the differences are, and does it actually really matter?
Well, I think I'll start with the does it really matter, because I think that investor attitudes, fears of greenwashing are basically catalysts that are showing the overlap between the frameworks for ESG investing, for development finance, and the whole issue about data that you really can't put in any level of accountability until you have better data. So I think there's a lot of overlap between the whole alphabet soup, and that captures the different elements of ESG investing. And some of it skews it towards more development outcomes, but sort of maintains a traditional ESG framework, which is, I think, pivotal to attract new capital to emerging markets in particular. So I think that just the dialogue we've been having has been with a lot of the multilateral development banks, and ways in which the private sector might be able to partner with them to really implement more development finance as sort of a part of the ESG strategy. So is there room where you could see more public-private cooperation for innovation in years to come? And I think there's also a lot of focus on the lowest income emerging markets countries, which have larger financing gaps and some of the lowest ESG scores. How can they attract capital, and how are we really kind of blurring the lines between what we call development finance, sustainable finance, green bonds, and ESG? So I think that I don't know if it matters so much as that what matters more importantly is the way in which we tie it to ways in which capital might be raised for some of the countries that need it the most. Now, I think in the US, there's a lot of talk about stakeholder capitalism, but I would still just say that the vast majority of US corporates, 70% of them, remain incorporated in Delaware, and that's a state with shareholder-centric corporate laws. So stakeholderism is going to endure in the US because it really does reflect the way that work arrangements are changing, public opinion is changing, and also a bigger government role in the corporate sector. But the reality is that the legal framework isn't really there. So it's up to each corporation on how they implement it. And I think for a lot of the lower income countries, they would like to turn ESG into something that's not just mass marketing, but a way to raise development financing. And so I think that the whole range of alphabet soup is just showing more overlap, as companies sort of grasp with the reality of implementing this. And the key thing is to move beyond just having guidelines to having things that are enforceable, accountable, and also for the poor segments of the population where we can really tie it to some financial solutions.
Thank you, Joyce. And does Omar, do you have anything to say about this one?
Alphabet soup. I certainly do. I think the key thing is you think about it. You have GRI, SASB, integrated reporting. It is a fairly large continuum. What's important is as Nick has shared and Joyce has shared, there is a convergence happening. But I think the key thing is what's important to investors and consumers is that being disclosed adequately. So if you think of, at the moment, we have 920 odd companies listed on the exchange. We have 75 who are on the FTSE for Good index. It's not the be all and end all, but there is an active conversation taking place with institutional investors asking, what is the disclosure you want? Nick shared, Joyce shared, there's not a lot of data sets out there to actually make informed decisions. And so the conversation at the exchange we're now having with PLCs is, what are you disclosing? Is it readable? Does it move the dial? And as we improve disclosure practices, disclosure practices should be what investors are looking for from that PLC. And that, let's not worry about the alphabet. Let's just actually talk about what we are disclosing and how we disclose and how we make it easier to read. So at the exchange, we have Bursa link. That's where you load up your annual reports and your data sets. And the conversation we're having with institutional investors is, what is the minimum what do you need to see as an investor to make an informed decision for different, because it's not one size fits all. So if you're a plantation company, you have to disclose something. If you're a power entity, are you renewable? Are you coal? What are you using? And beginning to show that clearly. So as we move to better and more meaningful disclosure in a reasonable, at the moment, if you read some sustainability reports, they're actually very pretty, but it's very hard to find data sets. So we want it to be, you may present your data any way you want, but let's have meaningful data underneath it. And then we're going to start having a look at, well, how do we ensure that that data is verified? I mean, so is there a third-party verification of that data? So that becomes part 2 of the journey. So first part of the journey is for investors to be very clear what moves the dial for them and having a meaningful discussion with their investee companies. We will facilitate that disclosure and work with those companies to make that disclosure real, because then I can demonstrate, if you do this, investors understand what you're doing. They will then support your company. You can raise capital cheaply or cheaperly. And I think, touching on what Joyce has been touching on about development, I'm very interested to see whether we will have capital relief for banks if they issue green assets, green sukuk. What is the capital relief given? And that is a way society through central banks and capital governance structure, and you can actually quantify the risk attached vis-a-vis an ESG product versus a non-ESG product, and actually provide capital relief to drive better behaviour. I think that's an important piece that we need to also tease out and begin to look at.
Absolutely, this is a question we ask our regulators all the time. Thank you for bringing that up. So maybe we'll come back to Joyce, right? Who is on the research and on the investment side. What data points do you think are the most important, and how exactly do you use these data points in your decision-making process, or how do investors do it?
Just unmuting myself. So, we've actually come up with a number of tools at JP Morgan to try to come up with ways in which investors can, easily make a passive investment into ESG. So let me just talk a little bit about that. We came up with something called ESGQ, which is a scoring system. And we now score a number of corporates on different measures. It's basically a quantitative tool to score companies and try to help investors pick stocks in a responsible way that outperforms the index. So we have different categories. So we call one best in class strategies, which companies are following best in class strategies, and we try to score that. We look at more norms-based screening, and a lot of the ESG has been negative screening. Basically, which companies do you exclude because they either violate the UN Compact, or they're tobacco companies, or you basically have a negative screening score. And then we look at ESG integration, and that actually is something that has been used as an approach in Europe in particular, just how they've integrated ESG into the corporate strategy. And then we look at what we call like high sustainable risk. So we have actually developed a scoring system where we score the companies. The second thing we developed was a whole set of indexes, ESG indexes, where you can invest in countries that and based on the ESG score that they have. And so we've scored countries like, let's just take, for example, an emerging markets index. Compared to the benchmark, our ESG emerging markets index actually has a lower weighting in China because of the human rights and democracy concerns. It excluded countries like Venezuela that were not performing. So part of this is we've actually developed criteria and indexes so you can do a passive investment, and we've tried to develop criteria that can be used in a corporate context as well. And and I think this is kind of what investors want. If you want to move beyond guidelines, you need to create products that make it easy for investors to basically have a more data-driven approach. Now, the quality of the data is a really big problem, and there's a couple of ESG data providers that have really been the key ones to go to. That's MSCI, Referis, Sustainalytics. It's very hard for any company to sort of develop their own ESG metrics, and this is also one reason why it's so skewed towards the E and away from the S and the G. So I often get the question, it's Women's History Month in the United States, why isn't gender a bigger consideration in these indexes? And that's because you can't get the data. The two things you can get data on are women who sit on boards and women in the C-suites, but other times there are some very good data points, but they may come off in a study or be updated once a year or once every other year. So there's no way to put that into an index. So the way that we collect data, we rely on a lot of these ESG providers. We've tried to develop passive index tools. We note that many of the indexes, are more skewed towards the E because you can measure pollution. Companies have to report more on that than some of the S and the G indicators, which just don't have very reliable data released on a routine basis that makes it easy to put into an investment product.
Thank you, Joyce. I think I'll now turn to Nick and talk about collecting data for sustainability, especially from the social perspective, right? So environmental data, it's people, at least we know what it is. On the social side, it gets a lot more mushy, maybe. So what are some of the barriers that you, as a primary researcher, what are some of the barriers that you find in trying to gather some of this research, and how much of that understanding is there actually?
So, Lloyd, I could go on about this, so I'll try to keep it short to maybe 2 or 3 points. But I do want to pick up on something that Joyce mentioned earlier as well. I think the first thing is that, as E becomes more easily measurable, right? S and G, I think, is the trickiest part to measure. G actually maybe less so. I think G, we can kind of agree what good governance is. S, I think, is really hard. And the reason for that is because we really have to understand that societies in different countries are very different, and the social norms that exist in different countries are very different. So, for example, in country A, let's say let's say a country in Western Europe, right? The kind of social priorities they might have could be very different from what we might have in Southeast Asia. And so if we sort of just transpose everything to Southeast Asia, then it might actually not work very well because our social norms are not suited for it, and ultimately you don't get to match that, right? That being said, I think we can agree that many of the social things are things we can agree on, human rights and so on, but not everything is the same across the societies, and I think that's one of the most wonderful things about humanity, that we're just very different. I think we should accept that. And this goes to point 2 for me, which is that what I worry about some of the data as well on this is that if the data provider is very biased in a certain way, especially on S, then actually it dictates social norms in other companies or other countries, which may not be suited for those countries. And I do worry about that. So, especially for a smaller country like Malaysia, where we typically are more takers of such things because we don't have the global reach of some of these data providers, I do worry about that. And the third point on gathering data, I think the part that's really, really difficult, and Joyce alluded to this earlier as well, is that actually for an investment fund like Khazanah with different asset classes, private equity, public markets, real assets, all of them have very different types of data sourcing, and especially in private equity. Negative screening is one way to do it, but actually there's no real standardized way. So I don't know if there's a comparable way we can do it. Some investment funds already try to put that kind of screening in, but really negative screening is probably the best we have at the moment. But it's just really tricky just because the standards are so different. And I think more important, we really do need to understand that we have to be very nuanced about the S in ESG, because different cultures around the world can be very different, and we should appreciate that and understand that rather than trying to impose a one-size-fits-all type of data category.
Thank you, Nick. Now let's turn to greenwashing, because that term has come out, and I think it is something that is really important. I think there are a lot of companies out there, especially the big corporates, who put out very nice looking sustainability reports with very pleasant photographs. But is it real? So how? I guess the question is, maybe I'll start with Dr. Omar. The question is, how can you actually tell if a company is greenwashing, and if they're not, how, as Bursa, how do you help hold them accountable?
Yeah, very good question. I think the key thing is it's about verifiability of data sets. As you quite rightly said, Lauren, when you see a very pretty document with lovely pictures, you have to go back to the data that's actually underlying it. And are we glossing over something? Now, I'm not suggesting those companies that have very good presentation, such as your own, would be doing that, of course. And at Bursa, we put a lot of effort into our sustainability reports, but the data sets are there. So the key thing around greenwashing is to actually look at what data is being presented, and has that data been verified. Now, from an investor or a consumer perspective, it needs to be easily seen, and you then have an ability to question it. So from Bursa, this year we were going to have a review of the Sustainability Disclosure Framework, designed to actually empower investors and consumers to actually make informed decisions. So that's the first step of providing beta data sets to investors and consumers. Then from that, of course, as Nick touched on, if you have a global index, it tends to be skewed to certain societal norms on a larger consumer base or investor base. But we take on board, perhaps on a very basic level, here is a data set for you, here it's presented in a way you can understand. That will then allow for assessment to be made on greenwashing. We're now also looking to actually create a class of a new professional who actually helps us and helps PLCs actually write a qualification around presentation of data and so on in this space. So there is a degree of consistency. So while we have alphabet soup, that drives a bigger picture, if you like, but the underlying building blocks is verified and people can understand it and it's clear. So I have a vision that when you look at an annual report, which is your figures, etc., there will be a very for each industry or segment, based on geography, there may be a document that just gives you your data sets. It's not pretty, but it's all there. It can be picked up by an AI, because we use a little bit of AI at the moment to actually read our data reports, and we tie it back in to see whether it makes sense or not. And what we're seeing is a lot of histograms, a lot of pie charts, but not a lot of data. And that's what we need to tease out.
Yes, and the way, Nagara is going as well with the Joint Committee on Climate Change with the Securities Commission, they're asking the financial sector to start adopting some principles of TCFD pretty soon, no timeline yet, but that would mean that all the companies that are investees or that banks would lend to would now start need to disclose a lot of this data. So, okay, moving on to Joyce. What do you think of this whole greenwashing thing? How often do you see it, as real or just for show? And how can you tell?
Well, look, I think there's a lot of hype around the whole ESG thing. So I've seen, numbers like the PRI reports. There's 44, trillion tracked against ESG, and there could be, 44 trillion that has companies that have guidelines in place. Like, who doesn't have principles in place about this? But if you actually look at what is genuinely tracked against ESG, with respect to all the issues we talked about, data accountability, transparency, disclosure. I mean, we come up with a number that has grown tremendously over the last year, but still more in the order of 7 trillion, not 44 trillion. And so I think that, we've had this big uptick, I think, because of COVID-19. in investing in ESG. You also had a year where energy really underperformed. So this was a year where ESG funds outperformed. Typically, they've performed in line with the index. This year, they actually outperformed by 40 basis points. But I think you look at whether companies are actually committing capital to this. So JP Morgan has long had ESG guidelines, but this is the first year where we put out a number. We basically said we're committing $30 billion over the next 5 years, and then we delineated what the initiatives are. 14 billion is for new housing loans to African American and Latino borrowers. 8 billion is being made available for affordable housing. Mortgage refinancing is another 4 billion. 2 billion is for small business lending, and 750 million is supposed to be spent with Black and Latino suppliers. So are companies and banks really starting to outline a firm financial target and disclose where they are spending that? And that's something that still, is quite a long time in company. It's very easy for a company to say that they have ESG guidelines. And we are seeing, more concrete steps that are being announced, that there's, more requirements about having women on the boards of the companies, not doing business if there are not a certain number of women on the boards. We see, like at JP Morgan, that there's a real clear effort to say we're going to align with the Paris climate financing agreements, and also aim to have the company reduce its carbon footprint and by a certain target by a certain year. So I think what you want is real firm and measurable targets where CEOs have been willing to come out and quantify what they're doing instead of saying just that we think this is very important and we're focused on it.
Thank you, Joyce. Now, I'd like to turn a little bit to the questions that we've received from the audience. So we have a couple of good questions. Please keep sending your questions in through Slido. This one, I think I will direct to Nick. Are there sufficient incentives or regulations in the market to increase corporate sustainability practices? What do you think about that? And I'm going to add my own question to that. I'm going to say, how should people be incentivized to do the right thing? Over to you, Nick.
So I guess the opposite of that is, if you don't incentivize people, will they do the right thing? I think the answer is not always. Some people might, but not everybody. And I think, if we're trying to achieve, this is something that this is something that I think makes a lot of sense when it comes to topics like this, where you're trying to achieve an outcome which we believe is good. How you get there within the boundary, within an ethical boundary, however you get there, right? So I don't think we have to be sanctimonious to think that, let's not put incentives and let's believe in the better angels of people. No, let's put incentives, because look, even take personal donations, right? There's a tax break associated with it, right? If it encourages more donations, why not, right? Where I think we draw the line is anything that is unethical. I think that's clear. But within that, I think if we believe an outcome is good, let's try to do that. Whether there's sufficient regulation in the market or not, maybe Dr. Umar is better suited for this because he's actually a regulator, right? But for me, I think within the constraint of ethical boundaries, by any means possible, to achieve whatever outcome you believe is good.
Yeah. So I think I'll turn to Dr. Umar now. You talked about some of the incentives and potentially capital relief for banks and things like that. Because a lot of companies that we speak to think, or one of the key challenges or barriers to them doing this is that it's an investment, because they need to make capital improvements, maybe have a team to comply to regulations or higher standards. So it's a cost, right? So do you think then that in the longer term, this actually becomes something that is positive, therefore companies should be looking at ESG as more of an investment rather than a short-term cost for today? And what do you have any, have you seen any of that data around that? How do you, what are some of the outcomes that you've seen?
Thanks. Well, I think that the key thing is call to action. It is an investment, it's not a cost. Again, it's glass half full, glass half empty. It depends on how you want to view it. But from our perspective, as we engage PLCs, it's very much our messaging, this is an investment. Now, the pushback, of course, from management and boards of directors is explain to us the causal nexus between this investment and superior performance. Now, we have seen through the course of the pandemic, companies that had sustainable supply chains, had addressed some basic issues, have done better than those that have not. So that's a truism, and data supports that. But as we go forward, as we come out of the pandemic and vaccinations increase, do we go back to the new normal? People say, it's often said, we have short memories. Do we go back to thinking how it all was, or do we take on these key learnings of inequality has led to certain outcomes and we actually embody it? And as society, do we say this is what we want? Now, if society says this is what we want, consumers then reflect that purchasing behaviour, investors then reflect it. As a director, I will see a causal nexus between my behaviour and the investment we make in ESG and disclosure. Now, I think that we need to make it easier for people to take incremental steps, to be frank. And at the exchange, what we're doing is we're upgrading Bursa Sustain. We've got that thematic review of disclosure where we'll have opt-in. We're very much encouraging better behaviour rather than mandating better behaviour. When you mandate better behaviour, you actually basically create greenwashing, because you're saying, you must have this, therefore I will comply. So at the moment, as we do reviews of sustainability reports, we actually see common phrases, it becomes boilerplate, it's not being embedded in the culture of the organisation, it will not necessarily show the right result. So what we would now want to see is, and I encourage the audience, your ringgit, dollar, whatever really does make a difference, and spend it wisely and send the right message. Because when you send the right message, it makes it so much easier for investors as well as boards of directors to make that investment in sustainability. If the message consumers give us is we don't care, then it becomes we're imposing our values on a much larger community, and who are we to tell them what is right? So we have to take that lens, if you like, and always be mindful and not be so arrogant and say, well, society is moving in this direction, it is an investment, it is not a cost, and we have to bear that and make a long-term view. But I was just flicking through the Slido questions as well, and through the pandemic, sustainable entities have performed better, and that's providing this cause. There are two calls to action. One is the performance of companies that had sustainability, and the other is society has realised society needs to have a look at how it behaves to all members of society, and make sure we are inclusive rather than having a world of have and have-nots.
Yeah. Thank you, Dr. Omar. Turning to Joyce now. There's been a lot of research which shows that companies that do better on sustainability, and Dr. Omar alluded to this as well, actually perform better performance financially. So, but the question is, do you think this is correlation, and does it also mean causation necessarily? What do you think?
So, in 2020, we actually saw much greater evidence of positive correlations between ESG and financial performance. Now, 2020 might have been more of an exception simply because traditional energy underperformed so much. But if you actually take a look at the Morningstar funds, 64% of US sustainable funds were actually in the top half of their categories. So the key point we would make is that you've been able to perform in line with index historically with ESG funds. I would not say outperformance has actually been that common, but perform in line. But what one can say is that when there are periods of volatility, that's when ESG outperforms. So if it's in a bull market, ESG may not be the outperformer, but in a period where you have extreme volatility, because there's lower weightings to some of the more volatile sectors, you typically do get, outperformance. And so I think that, the performance track record, it's very possible to devise different strategies where you don't underperform. But I do think that you're going to see just pressure that is coming not just from shareholders and shareholder activism, where large listed corporations, whether it's willingly or reluctantly, will need to adopt this. You're going to see it from the government itself, because during this crisis, the public sector ownership really increased in the COVID-19 era for certain sectors. So if you take a look at some of the OECD numbers, pre-pandemic, 14% of the global stock market capitalization was held by the public sector, either through direct government ownership or through sovereign wealth funds and public pension funds and state-owned enterprises. And for almost 10% of the world's largest listed companies, the public sector holds more than 50% of the shares. So given just the role the government had on fiscal policy, I just think the stakeholder capitalism is here to stay. It's then a matter of, data quality, how you implement it, how you make people accountable, what the transparency is. And I think that just going back to the whole performance issue, that I don't think you need to sacrifice performance. That's what our indexes and our scoring system has shown us, but you're not going to necessarily outperform either.
Can I just add a point or two on that to Joyce's point, Luann? I think just a bit of, so this is one thing that has always been a source of consternation for me, the question of performance, right? And I think one thing we should know is that not every indicator, meaning E or S or G, is weighted equally. What we find, the biggest correlator with performance is G, because better governed companies naturally do better, and therefore, as Joyce said, they tend to outperform during volatile times because it's just less risky when you're governed better. And this is especially true in emerging markets. So what we find is that in Asia, in emerging market Asia, ESG actually outperforms the non-ESG companies because of the governance premium. It's actually not from the E or the S scores. Whereas in developed markets, as Joyce said, during normal times, regulations and transparency tend to smooth out some of the corporate governance issues anyway, because they're just more advanced in their journey in that sense along the way there. But actually pay attention, I think there was something the question is, so pay attention to the G most of all, especially if you're investing in emerging markets in Asia, because there is a premium there to be had. And just be careful of correlation. Correlation is not causation. And the other thing is also, do you have to do good, therefore you can do well, meaning your returns are better? Or is it because you perform, therefore you can do these other things that are good? We don't know. But just watch out for the G. Thanks.
Thanks for that, Nick. Coming to a few of the questions that we're getting from the audience, one of the top voted question is actually, I think all of us and all of you have talked about stakeholder capitalism and that it is necessary. But the question is, who should make the first move? Should it be the government? Should it be private industry? Who? Nick, why don't you start?
So I've never really been a fan of waiting to do something if you think it's good. So I think sometimes you have to ask for forgiveness, not for permission. So if you believe something is good, go ahead and do it. I think corporates do it. But I think it's also imperative that corporates bring governments along on this journey, because it's impossible to have, ultimately what you want is actually an overall society which is sustainable, which is healthy, which is all of these things. And you can't do that without government. So anytime corporates do something, but you don't bring government along with you, it's actually going to be long-term very problematic, even if you believe that the government is more harmful than helpful at the current point, for whichever government, right? So actually one thing I would suggest for companies, if you're looking for CSR to do, one thing could be actually starting a fund where you actually send government servants, civil servants, or government officers for training and build capacity within the civil service. Because honestly, if all governments could do their job well, some of the sustainability things that corporates need to do, actually you don't have to do. The reason there is CSR is because there are a lot of groups of people who fall through the cracks. Okay, if the government was doing a job, entire groups of people wouldn't be falling through the cracks. It might be individual cases, but the fact that entire groups of people, I mean, Joyce mentioned earlier, with COVID in the US, a lot of minorities and women were disproportionately affected. If there was proper government support, you might not have to deal with those kind of issues at a group basis. So I think just start first, but definitely bring government along. Thanks.
Thank you. Same question to Dr. Umar. Government corporates first.
One would hope governments are elected, so then governments would lead. But if society and needs are moving quicker, then you have to act fast. And then it gets back to that theme of, although I do sound like a broken record, is rewarding good behaviour. Because I think a case in point is you look at the use of sugar in our diets, smoking. These are unpopular moves, but they're actually better for society overall. So you have to lead from the front.
Yeah, no, I think if you look who's furthest ahead on ESG, it's Europe, and it's because government policy has really led and mandated that. And we look at ESG investment, when 80% of the funds that are invested in ESG products are actually based in Europe. So, in Europe, you have the EU Green Deal that went even greener over the past year. And it includes climate targets, disclosure requirements, adoption of green budgets. And so the policy really does make a difference in basically setting the radar. And as I said, just given the government's greater involvement in this crisis, the amount of fiscal stimulus that was used, it makes a real difference. But the government is very much sort of setting the tone on the data requirements and the transparency. So I think that the private sector has had no choice but to come on board. The government policy leading it, you can see how this really has made a difference when you look at Europe. But even in Asia, you had this past year, China, Japan, South Korea all announced net zero carbon neutral targets, and even China basically outlined when they want to reach peak CO2 emissions and then try to achieve carbon neutrality. So I think government policy makes a very big difference on this one, because the accountability would be much harder to put in if you just kind of left it without having some level of standardization and guidelines.
Thank you. And coming back to the incentives versus regulation question, so incentives would always have a few over the line, bring a few companies over the line, but regulation is needed to kind of bring everybody up to that standard. Now we've got an interesting question here about SMEs and sustainability. So corporations and large corporates have the resources, they have access, and they can do a lot of these things and a lot of the best practices. But how about SMEs? And keeping in mind that SMEs are the largest component of the economy, especially in emerging markets. Starting with, actually, whoever wants to speak. Anybody?
I can go first.
Yeah.
So the reason why I wanted to go first is literally because on Twitter this morning I read about a new paper that was published, an economics paper, which showed that when Amazon hiked their minimum wage to $15 per hour, I don't remember which state it was in. Actually, what happened was other smaller businesses around also managed to hike their minimum wage. So I think in terms of SMEs, what you might need is for the larger corporates to take a lead on some of these measures. And the mechanism, the channel or mechanism for how these things flow through could come in many different ways. But to, I think, set an example matters. And from there, it's doing things like responsible procurement, because we've been talking about responsible investing. I mean, Dr. Umar is on Bursa, Joyce is looking at financial markets, Khazanah's investment fund, but I think responsibility can flow through the entire business operations, including our procurement and things like that. And if you, honestly, sometimes, when, as a shareholder, if you tell your company to do something, but you yourself don't practice it, it's also a bit silly. So the same way for the large corporates, if they're going to set responsible operations throughout their entire business processing line, then they have to do it, and it's a good place to start. And I think the Amazon evidence that literally the paper just came out a day or two, shows, I think, some promising work towards that area.
Excellent. Dr. Omar or Joyce, did you have anything to add about that?
I mean, if I may, I echo Nicholas's view. At the end of the day, if you want to bring SMEs along on this journey, you have to support them through your procurement practices. And so when you want to see provenance and verifiability as a larger, someone who buys SME services, you then support the SMEs that provide it, and then you bring the whole community along with you. So you actually lead by example, you lead by your consumption. These are the themes that we've been talking about, no different from investing and consuming product.
Joyce, did you have... No?
I have to agree with you all of the comments. I do think, though, it's harder for some of the smaller corporations to necessarily feel like they have the resources to put this into place, but they also probably have more of the necessity as well. That just issues like taking care of the employee safety and health concerns are such a high priority if you're an SME. But I think that's one where just resources make the institutionalization a bit harder.
Okay, so now I've got a very specific question from the audience to Dr. Omar.
Yep.
When will Bursa require a higher reporting standard against measurable metrics on energy, water, waste, GHG?
I think I touched on that. We're going through a process this year where we're actually having a thematic review of sustainability reporting. But I wouldn't say hesitate, but I did caution that as you start defining these matrices, which are not verifiable, you'll end up with greenwashing. As people don't necessarily, because it forms a part of the annual report. Is it a legal document, not a legal document? So we'll take that forward. But I think it gets back to ensuring that there's adequate disclosure so people can make informed decisions. Hence that comment, take Bursa link, put in data sets, move that along, and that's our task for 2021.
Excellent. I'm glad to hear that. Okay, we've got another question here about climate issues. Climate issues are among the top 5 risks in 2021 by the World Economic Forum. Sorry, this is Bursa again. What is Bursa's role in promoting higher quality climate disclosures? So this is very specific to climate.
I mean, at the end of the day, it gets back to how I answered the first question just then. Yes. I think there are 2 pieces. I think climate's very important. I would then moderate that, saying that for specific industries, climate will always be there, but we would like to tease out what is important to consumers and investors for other sectors as well and geographic locations. So yes, it will always be there as a given, to be frank, and that will then fit into the overall disclosure requirements.
Okay, so I think I've gotten through most of the questions from the audience. So perhaps if I would just go a final round of, just between all the panelists, maybe 2 things. One is, what do you see as the greatest single challenge in sustainability or corporate sustainability moving forward? And 2, what do you think the audience listening here today can do about that, if anything? Can I perhaps start with Nick?
I think the greatest challenge, and I think it's been alluded to repeatedly by Dr. Umar actually, is on what people want and trying to change preferences and attitudes and norms in society. That's always hard, but it's possible. And we've shown over time that things can move in a certain way, and when the iron is hot, you have to strike. So I think right now, I understand that there is a lot of, and this is more for emerging markets, Malaysia type of issue, right? I understand there's a lot of concern on sustainability when it comes to the environment and climate change, but at least in the short term, for now, consider the fact that maybe we should be prioritizing governance, and that many emerging markets at least in Asia, because those are the ones I cover, so I do feel a bit more comfortable speaking about them. And certainly in Malaysia as well, we do need to improve a lot of governance practices, and maybe that is the greatest challenge, because in Asia, unlike in many Western countries at the moment, way back then, when maybe the robber barons in the US were much closer to government than maybe they are now, right? At least in emerging markets in Asia, there is still a lot of relationship between government and business. You have to look no further, whether it's in China or Korea or even in Malaysia. So then how do we think about improving some of the governance, right? In terms of what the audience can do towards this, I guess if we're going to change norms and we're going to change social behaviors, it does start with us. And I guess I would encourage you to think about where your boundaries are for certain corporate practices, right? And also, if you are working in a given company, or you're looking to, let's say, invest in a certain company and that kind of thing, try not to look at just what they say they do, but what they actually practice, because it's very easy to compartmentalize your sustainability actions versus your actual business operations. For example, you could embark on, let's say, energy efficient lighting throughout the whole building, but your company is one that, let's say, repeatedly rips off people for whatever reason, sells snake oil, right? First example. So I think just be more mindful about what behaviors and what constraints that you have in determining what kind of products you buy, what kind of companies you want to work for, and ultimately what kind of companies you want to invest in. And lastly, hold government accountable, because corporates should not be doing the jobs of governments ultimately, and we do need governments to work properly in the long run. Whatever, when it comes to CSR, the things that companies do that counts as sustainability one way or another, I think I just want everybody to just remember that generosity is not justice, only justice is justice. Thank you.
Thank you, Nick. Over to Dr. Omar. What would you say is the single biggest challenge or barrier to advancing sustainability, and what do you think individuals here can do about that?
As the clock runs down the line, I'll be very brief. Issue is the nexus between the time in the investment in sustainability and then seeing the benefit from said investment. You have to convince your board may be skeptical. That's probably the challenge that I see as my 2021-22 challenge, not for the exchange, but for the exchange as a regulated exchange is trying to drive better behaviour. Noted what Nick is talking about governance, it does shift the dial, but I believe we need to actually drive that question around that nexus to make it easy for companies to adopt better behaviour. The other key challenge is then providing data sets that make sense, which is what we've seen from the Slido questions as well as our conversation today. So consumers, go out there and buy green product.
Absolutely. And finally, to Joyce.
So, let me just add to the excellent points made. Leadership is a key challenge, and I think you can really see that in the United States. There was a real question at the beginning of the pandemic about whether this would set back ESG under the Trump administration, whether there would just be more allocation of resources to emergency services, less focus on ESG. But what we have seen with the election of Biden is a return to some momentum on ESG, that the Build Back Better plan has at the core of it, a green recovery. Now, whether he can get all of this through or not, it's been a real sea change that you can just see from a leadership point of view. It's changed the policy priorities, the language, the way that businesses feel that they need to react. The first actions that Biden took was rolling back a lot of the things that were, like joining the Paris Climate Agreement, appointing a climate change envoy. So I would just say that policy leadership is key. And as somebody who's a researcher, then I think it is data standardization and data quality, so that there really is some ability to enforce and to define what it is.
Thank you very much, Joyce. And we are out of time, so I'm going to wrap this up. I would like to thank the panelists today for such a great discussion and really, really very cool and diverse insights from all over the world. And we've heard about greenwashing. I think everyone agrees that corporates need to play their part, but everyone else, including governments and individuals, need to do that too. And also about governance, which is actually something that may not always be the first thing people talk about when they talk about sustainability, but actually is really, really important. So I'm going to wrap it up now. Thank you so much to everyone, and I hope you have a good rest of the conference. Thank you very much.
Thank you very much.